This is August 18th, 2026. This essay is on the stock market. And I've got to tell you, the stock market is driving some old dogs like me crazy. I was a stockbroker over 45 years ago, back when there was even, such a thing as a stockbroker. The industry is gone. It no longer exists. The stock market, i.e. the Dow Jones Industrial Average, the S&P 500, the NASDAQ, etc., used to be what we would all point to tell us how the economy was doing. The stock market was, probably the biggest and most followed leading economic indicator. Now, it no longer is. Today, it doesn't work like it used to. I'll explain that in a minute. But first, let's look at it. This is the NASDAQ. It's a picture of the broad market. There are over 3,500 stocks reflected here. The NASDAQ is up 23% over the trailing 12 months, and it's up 192% over the last 5 years. Next, we'll look at the S&P 500. This is the S&P 500. It captures the value of, just 500 companies. But those companies reflect about 80% of the total value of the stock market. It pretty much is the stock market. If you look at only one data point, this is the one you want to look at. It's up 22% over the trailing 12 months, and it's up 141% over the last 5 years. Next, we'll look at the Dow Jones Industrial Average. This is the Dow Jones Industrial Average. It reflects just 30 of the largest companies in America. It's the oldest market index we have. It started in 1896, and that's a long time ago. Back in my day, in the late 70s and early 80s as a stockbroker, it was pretty much what everybody looked at. As of today, it's up 19% over the trailing 12 months, and it's up 86% over the last 5 years. Okay, now let's stop and look at the stock market as a leading economic indicator. Okay, you're going to have to hang in there with me on this. I'm going to contrast some of the basic data points within the economy and compare that to the stock market. And I'm going to make the argument that they don't match up. And the fact that they don't match up is what has got some old dogs like me scratching their heads. First, in regard to the stock market, it's the highest price earnings multiple in history. The Case-Shiller is at 42 PE. The average is around 15. Price to sales ratios are at 3.83. The average is approximately 1.5. Both PE and price to sales ratios are literally twice as high as average. The price to book value is at 6.15. The average historically is around 3. Again, twice as high. The point here is this. The stock market is at some of the highest price levels in history. Okay, again, you're going to have to hang in there with me. I'm going to have to touch on some of data points or arguments that are negative. As such, they run contrary to these high stock prices. Just to touch on a few. First, we have the war in Ukraine. Right, wrong, or indifferent, that conflict is affecting upwards of 14% of the world's oil production and distribution and 17% of the world's natural gas output. We have also, the war in Iran. And as most of you know by now, with the Strait of Hormuz, that affects up to 20 to 25% of global petroleum and LNG, or liquid natural gas, supply. We also have the Houthis in Yemen, challenging the Strait of Bab el-Mandeb, going into the Red Sea towards the Suez Canal. That accounts for upwards of 12% of global seaboard traded petroleum. All in all, that adds up to a huge amount of the oil and gas supplies worldwide. Point being, the stock market isn't even saying ouch. It doesn't even care. Now, let me explain why. It comes down to the concentration of wealth. 88% of the stock market is owned by just 10% of the population. Now, let me repeat that so it sinks in. 10% of the U.S. population controls 88% of the stock market. Now, having said that, when you look at individual stocks, you've got NVIDIA, Microsoft, Apple, Amazon, Google, Facebook, and Tesla. Just these 7 companies are worth $20 trillion in market capitalization. To put that into perspective, the GDP of the European Union, that's 27 countries, is $25 trillion. Just these 7 companies are by themselves 80% the size of the European Union. On top of that, the top 4 asset management companies in the U.S. control $36 trillion. Blackrock's is $14 trillion, Vanguard's $12, Fidelity's $7, the Capital Group is $3. Again, in point of comparison, the GDP of the United States is around $31 trillion. These small handful of companies, via shareholders capitulating or delegating their shareholder voting rights to just these few asset management companies, they're effectively controlling much of the U.S. economy from the top down. The point being is that the concentration of wealth is so great that these guys don't need to sell. They didn't need to sell anything to pay bills at the end of the month or to put food on the table like you and I. They're totally insulated. Now, hopefully that makes some sense. Now, right, wrong, or indifferent, it's why the stock market doesn't necessarily reflect the rest of the world the rest of us live in. The point being is this: for real estate investors, don't look at the stock market for confidence. Whatever real estate you're looking at, whether it's on the buy side or the sell side, whatever it is, real estate has to stand on its own 2 legs. But having said that, we'll definitely need to keep an eye on the stock market. Until next month.